Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. Another week, Josh. How you going?
Yeah, mate, good. Always well. Closing out the week, another big and busy week. What's new in the world at the moment? Just all about really the baby at this stage. We're three weeks out. Yeah, as ready as you can be. We need to get through to the 18th though, because our private health insurance 12-month waiting period comes up then. So we've got exactly a week we need to hold off. So old Josh Jr.'s got to stay in the oven until then.
In the oven for a bit longer.
If not, we've got some issues, and I'll be up for a bit of a fight with the insurer. However, that's probably something worth mentioning for clients is that when you do get private health insurance in that 12-month waiting period, something I learned from that whole situation was when you actually test and you're positive, you get the positive for the pregnancy, the baby's actually already a month old at that point in time.
Right.
So
wow.
when they say 12 months, really, you need to be aware, like really pregnancy is 10 months. I don't know if you knew that, Steve, but really pregnancy is actually 10 months. It's not 9 months. So I'm actually going to do a video on that one for social media because it nearly tripped us up and nearly got us to the point where if baby comes out earlier than the 18th of this month, I'm up for a fight with the private health insurer, which has costed us a lot over the last 12 months to have that cover. And if we don't get the benefit of it, they're gonna hear from me. So I'll make sure I do a video on that and keep everyone in the loop. But what's new on your side before we get into it?
Mate, nothing new on my side. I've had COVID for the fourth time this week, so it's been a bit of a dull week this week. But managed to keep on working, which is good. But if we get into today's topic of conversation, mate, tax structures. We talk a lot about tax structures, and we'll deep dive today into one in particular being superannuation, and really it is just a tax structure. It's a holding entity for a tax structure. But if we rip into it, mate, and kick it off, what is the major benefit of this superannuation world and that tax?
Yeah, the big one is just really it's the most tax efficient structure in Australia, hands down, no questions asked. So, income from your investments through superannuation is only taxed at 15%, which is amazing. And then your gains on any of your investments, if you're to sell any of your investments, if you've sold within 12 months, they're taxed at 15% also. But if they're sold after the 12-month period of time, you only pay capital gains at a rate of 10%. So it's the lowest tax environment that actually exists here in Australia, which is amazing. You also get a break on putting money into super, so you get a tax deduction if you were to add extra money into superannuation. There's two types of contributions you can actually make there. The one to get a tax deduction is your concessional contribution. So you've got to be aware of what your employer is already putting in there because there is a limit to the concessional cap this year. It's $30,000, has been going up over the last couple of financial years. But you can actually place some extra money into your super and you can then claim that back as a tax deduction or do it also through a salary sacrifice arrangement, which is where your employer is actually deducting some of your pay. And rather than that going to you personally, they put it into your superannuation fund and you're getting a tax saving from there. So that can be quite beneficial if you take the view that if you're in the highest tax bracket and you're paying 47% on the dollar on any of your earnings over the 190, putting that in super, if it's only taxed at 15%, that's a pretty sweet deal. So tax deductions on the way in, tax effective when the money is in there. And then ultimately, when you get to the ripe age of 60, of which you're approaching quick, Steve, I'll let that one go through. When you hit 60, you can be tax free. Your money in there can be tax free, and it's not a catch. A lot of people think super is actually a scam. I see it a lot on my social media. People commenting saying, "Don't put money in super. I've lost it. It's a scam. It's the government's money." No, it's not. It's definitely your money. The government actually want you to build your super, so you're not going to be relying upon Centrelink when you get to retirement. And from 60, it can be tax free if you meet a particular retirement condition of release. So you can have up to $1.9 million per person, yourself and your partner, and that money be tax free. And there is no better structure in Australia that you can do that within, and you have full access to the money at that point in time. If you don't trust super, you could pull it completely out of the system and put it in your bank account. But what I would say there is what we're talking about today is effective tax structures. Why would you take it out of super when after age 60, it's all tax-free dollars, and then you put it back in your own individual name or bank account, and you're still going to be taxed on that interest? So Super. I love it, but we're obviously going to sort of unpack it through the podcast here in terms of, pros and cons and other bits and pieces there. But yeah, Steve, did I miss anything there you would throw in about super?
No, firstly, just want to clear it up. Early 40s, so very young. Still got a long way to go.
Good.
No, mate, I think you nailed it. Look, the benefits, like superannuation these days, you can buy anything in with your super, right? So it is just a tax structure. You can buy whatever you want as long as it's for retirement purposes. And the benefit is just that reduced tax rate over the journey. It pays 15% on earnings, but it has a very low capital gains tax rate as well. So if you're in accumulation phase, which is the phase while you're still working, about 10% is your CGT. So if you say you bought a property and you sold that property, well, the capital gains tax on the gain is circa 10%. So that's very beneficial. If you held that property then until retirement and pushed that superannuation phase from accumulation into pension, that CGT is zero. So you can pay zero capital gains tax on a property purchase, which is quite unbelievable. But look, I think, the closer you get to 60, absolutely, you've got to be maximising that space, right? Because it's no longer being held up in superannuation if you need to access it past 60. So it becomes very, very beneficial for people in their late 40s and 50s.
Yeah, no, it does. And I think it's also worth noting for high income earners as well, because a lot of high income earners then look at super and go, well, I want to get more money in there. But of course, the government's always got something for the high income earners and want to hit them with some extra tax. And that's where Division 293 tax comes into play when you're earning over $250,000. Your super contributions, which normally are only taxed at a rate of 15%, you're actually lucky enough to get hit with an extra tax rate of another 15% when you're earning over $250,000. So, of course, it's still then beneficial from a taxation point of view, but the government does get you on that side of things if you are earning over $250,000. But what if we talk about self-managed super funds, Steve? And obviously we do a lot of work in that space at the moment. We've got a lot of clients, a lot of interest in there as well. What's the go with self-managed super funds? Like, what's the difference between them and a regular fund? And what are we looking at in terms of getting these things set up? And most importantly, why do we look at that as a viable strategy for someone?
Yeah, look, I'd say this over the next 10 years with the wealth transfer in Australia, I think self-managed super funds are going to become even bigger and bigger and bigger, right? The popularity of them is going to explode because a self-managed super fund, all that means is that you've got your fund and you can invest it wherever the hell you want. You're not restricted by the fund and individual funds investment options. You can buy property with it. You can buy managed funds with it. You can do absolutely anything with it. And I think we'll see over the next 10 years with this wealth transfer between older Australians to younger, I think it's going to come up a hell of a lot because the starting point for self-managed super funds is about $250,000 or $300,000. So, and you can have multiple people in the one fund. So the starting point's low. The wealth of Australians going to get bigger and bigger. So I think this is going to come up a lot. We do a hell of a lot of work in this space. Why would you do it? Well, a range of reasons. Flexibility with options. As I said, you can buy property, buy whatever you want in a self-managed super fund for your future. Costs come into it. Sometimes it actually works out that it can be cheaper than investing in another type of fund. Having full control comes into it. You've got absolutely full control of your super. With your advisor, you can do whatever you want with it, stick it where you want, and ups and downs. So yeah, there's a lot of benefits, but the taxation of it is identical to a normal super fund. So it's the 15% across the journey, 10% CGT, and then once you hit retirement, 0% tax and pension phase. So all of that is exactly the same, but the flexibility and the costs and what you can do with it is far greater.
And I'd also say in their transparency as well of actually knowing what you're invested in. And that's where it's worth mentioning. And I've done a video, I'm going to put it on social media in the coming days, talking about the differences between like an industry fund and a retail fund, because a lot of people don't know, you don't have much transparency when you're in an industry fund because it's what's called like a master trust product. And that's another conversation for another day. But all of your money is grouped together with all of the other members. And therefore you can't actually break down and see the underlying investments generally and where your money is, where it's going, what your tax liabilities are, because you're grouped in all that with the other members. Whereas I suppose if you're in a retail product, that's different. You can actually see all of your investments. It's very transparent. But then with the self-managed super fund, you can virtually put it in whatever you want, as you were saying. But commonly, the only reason we're looking at them is for clients generally with wanting a property interest, and that's talking about looking at residential property most commonly, but then also
Yep.
commercial property. And that could be just for an individual wanting to diversify. They've already got a lot of residential property, maybe outside super. Now it's time to throw a commercial property in there. So that might be like a factory, warehouse, office space, whatever it may be, and can get some good and different returns rather than that of what you're just going to get in residential. But then also for business owners as well. I did a video earlier in the week in terms of why business owners commonly look at utilizing a self-managed super fund to buy the premise that they're going to operate out. And that could be a tradie wanting to buy a factory. And I used in the example of that video, say you could buy it from your company, you've got $500,000 and you could use that to go and just buy the commercial asset and get the lending through your personal company. But maybe in your company, you're also trying to go. So you want to hold on to as much of that cash as you possibly can, but you also need that, that warehouse or factory or whatever it may be. So that's where you could look at a self-managed super fund. And if you've got the right amount of assets and cash already in there, potentially you could have your self-managed super fund, buy the asset and then lease that back to your company, all at arm's length, paying market rates of rent. And you get the benefit of keeping funds in your trading company so you can continue to grow and reinvest, which is what you want to do. But then you're also getting your hands on that commercial asset and you're leasing it back to yourself. And hopefully then that's a good asset for you to hold into, the future ultimately for retirement. But yeah, the big one for SMSFs is you can borrow. You can't borrow through a regular superannuation fund. And what I mean by that is you can borrow to invest in property. So the banks aren't going to give you a loan in your regular retail or industry super fund, but you can actually get that with a self-managed super fund through something called a limited recourse borrowing arrangement. And it's a bit of a complex structure, so we can't hide the fact of that. If you go down this route, you definitely want a team around you because there's a few different moving parts and entities. It's a similar structure to a family trust. So there's a company that's going to be there, which is like the trustee company. There's the SMSF, there's the members. So there's a few moving parts. And then if you've got the property in there, there's this other trust that has to be set up, which is called a bear trust, which is basically like a holding entity, which holds the asset on behalf of the SMSF members, whilst there is a loan attached to the property. So in the event that the property defaults, the lender can't actually go for all the other assets in the SMSF. It can only take the property. So there's a lot of complexity in that, which can definitely be unpacked in other videos. But you got something to add there, Steve?
Well, I was going to say, yeah, what are the pitfalls? If say SMSF, what are the things that we should be looking out for here, or customers should be?
Yeah, I think the cost for one, like sometimes, setting it up, if we just talk about the cost, it varies on accountants. Some accountants could be $2,000. Some I've seen actually have been $3,000 to $4,000. So they vary greatly in terms of the average cost to set up. But yeah, there's the complexity of the management of it. And if you're going to do that on your own, I rarely see anyone with a self-managed super fund on their own. They've always at the very least got an accountant around them to do the audits and tax returns every single year. But then most clients obviously working with us, they have us as the advisor to most importantly run the investment strategy, because that's the most important part, is this thing growing, and you want to see that ultimately growing. And the rules are very strict in the SMSF space as well from a compliance perspective, and you don't want to be deemed non-compliant and you get hit with some of the highest tax rates around. I guess it's more important to talk about super in general, like the pitfalls of super in general. The biggest one is the lockup of your money, of you can't touch it until at least age 60. So that's where, like, if you're in your 20s and 30s, you got to really be thinking about, should you be putting the money inside superannuation, and are you willing to then forego that until age 60? And that's based upon the present rules as well. The government can always tinker with that. And it's worth throwing in Division 296 tax. And everyone's like, whoa, you said Division 293. What's Division 296? There's this other tax that's scheduled to come in. I believe it's July 2025 first. And that's looking at large super balances over 3 million. So clearly not going to affect a huge amount of people in Australia, but people with large superannuation balances, is going to be a new tax that comes in if it gets all legislated, and something to look out for, which again, we won't go into the weeds of today, because the government can always change those rules and regulations at any point in time. But like I said, it's really the lockup with super. If you want flexibility before age 60 to retire, super may not be the best vehicle for you. It's great from 60 onwards, but if you want to have some of that flexibility in your 50s, of which I know you do, Steve, super may not be the vehicle for you. I'm talking on your behalf.
Again, I'm still a long way from 50s, so
I
that's okay.
Didn't say you weren't. But then winding them down as well is it sounds great having a self-managed super fund. I've seen some situations where people have them and they should never have had a self-managed super fund from the get-go. They were in their self-managed super fund. They had a few direct shares and managed funds. And I looked at it, I'm like, you could just do this in a regular retail fund these days and have no administration burden and way less costs associated with it. I had one client, it was a pretty sad situation. Her husband passed away, over $1 million in self-managed super fund, and it was basically just all in direct shares, and it was an absolute nightmare to wind down and close down this SMSF.
Wow.
And this lady had no idea how the SMSF was structured, what she was invested in. She was never a part of it, and the whole family was then dealing with it with me in terms of getting this mess, and it genuinely took 12 months to get it done. So setting them up, there's a bit of a process there. You got the right team around you, it's easy. But again, you just want to be really certain. And we always say it in our, when we're talking to clients and on these podcasts, is you want to get those structures right from the get-go. You don't want to get 10 years down the line and wish you did it another way, or have to try and restructure it down the line, because it just costs you a bucket load of money. So there's a lot there. It is great, but there's definitely some things to be cautious. What about you, Steve? Any others that you say to clients when they're looking at this as an opportunity?
Get good advice here, because you don't want to stuff it up. There's lots of rules around accessing super too early. If you do that, you're in lots of trouble. Don't go over the caps, because if you do that, you're in lots of trouble. But look, for the right setup, and I must say this, if you're over age 60 and you're still working, you can do an amazing strategy called a transition to retirement strategy, where you maximise contributions to super in, claim the biggest tax deductions you can, and then if you need the cash, you can get it back out again. So definitely worth mentioning that one, because it's from a tax perspective, it can be very, very healthy. But again, like any investment strategy or any tax strategy, diversification is key. So whenever we're investing, and maximising that tax effective investing, we also want to make sure we're just diversified across. If you've got property in there, make sure you've got managed funds and cash. So you got to get the best of both worlds.
Yeah, no, I've been working with some clients as of lately where exactly that's the situation. Like, they had enough of a balance in there to actually buy property outright because their balance was large enough, but we didn't end up doing that, and we instead just put a 20-30% deposit down on the property through the superannuation fund. You can borrow up to 80% generally through a self-managed super fund. But the servicing is a little bit different. So the lender's going to be looking at the contributions going into the fund itself. And that's where it's worthy of probably talking about, like, who's this structure even suitable for? And generally, like you said earlier, 250, 300K balance probably starting, and then going up from there just due to the costs of setting it up. And realistically, if you've got a balance below that, in terms of property you're going to be able to buy and still keep diversification in the portfolio, it's probably not, you can't really do it unless you're buying a little 300 grand shed somewhere, I don't know where, and it's maybe might not grow that well, and I've seen that before. But a good balance always worth looking at from the beginning to weigh up against the costs. Nice steady contributions going in, ideally established careers, or you got a business. But ultimately, I only ever consider generally a self-managed super fund for clients that, like I said, just want property exposure, and they're going to be investing longer term, and I mean 8 to 10 years when we're talking from a property perspective.
Yeah.
Or business owners, it can be a little bit different. But we're definitely not looking to take all of their super assets and just lump it in a property. That client I was saying before, so say they had $500,000 in super, they're going to allocate $200,000 towards a property for the 20% deposit and their stamp duty. They're going to leave a little buffer left in cash to cover any admin fees, accounting fees, etc. And then also invest, say, $300,000 in diversified managed funds investment portfolio. So not all of that is geared into one asset. So that's a lot of generally what the overall outlay and it all looks like for clients that I'm mostly working with. But what about on your end, Steve? Anything else in terms of suitability for clients or?
Look, not particularly. Look, at the end of the day, it's going to be part of an overall strategy, superannuation. Yep. So, investments in trusts or super or in yourself, in your own names. It's a combination of all that, but superannuation definitely has its place. If you get it right, it can really maximise your growth because the tax rate's so low that compounding those returns with low tax clearly is going to make a big impact. Mm-hmm. And just really think about it. If you're in your 50s, especially late 50s, it has to be a big part of the conversation. It's crazy if you're not maximising it. So get some good advice there and, get into it.
Yeah, another bonus one. A lot of people don't know about this strategy called spouse splitting contributions. And weirdly, I've just been doing it a lot lately. I've had a lot of clients coming through, and there's this age discrepancy between them. So I've got a couple I'm working with at the moment, and one of them is late 30s. The other one is early 50s. So there's an age gap there. And so what we're doing is, because we know from age 60 onwards, superannuation can be tax-free based upon the current rules, we've actually got the younger member in this situation doing a spouse splitting strategy where 85% of whatever contributions they make every single year will be taken from their own fund and be split across and transferred into their spouse's fund. And the reason for that is that the elder spouse who's in their 50s, they're obviously going to reach age 60 sooner and therefore could benefit from their fund or those funds being in there and being accessible for one from 60 onwards, but more importantly, tax-free. Whereas the one that's in their late 30s, they're still, 20 years-ish away from being able to have that benefit. So there's a lot of strategies out there, and it's always best to obviously get some advice, because just doing little things like that over a 10, 15, 20-year time frame, it may not sound like much, but it can make the difference between you having a good and probably a great retirement as well. So I'll throw that one in there at the end. And of course, these stuff and areas that we're discussing, guys, they may not always make sense, and that's where you always want to be reaching out to an advisor if you've got any questions in relation to this. But we'll stop it there for today. That's all we do have time for. If you're getting value out of it, 5 stars on Spotify and Apple, because it does help us out a lot. Check out the socials. We're on everything, like I always say, LinkedIn, TikTok, Instagram, etc. We've got Steve's newsletter that goes out every single week. And as I was saying, if you want to chat to any of the advisors in the business, hop on the website and you can book in for a 15-minute call, and we can actually discuss your situation and whether strategies such as what we've been talking about today are even relevant for you. But till next time, Steve, I'll see you then, mate.
See you there, mate. Bye.
Cheers.